This is Kevin, and he's got a huge problem. See, Kevin did everything right. He paid his bills on time, he kept his credit card balance low, he never missed a single payment in 5 years. So when Kevin applies for an apartment in a slightly nicer part of the jungle, he walks in expecting a formality. A quick signature, maybe a handshake, and the keys. Instead, the landlord pulls up a number on a screen, frowns, and says, "Sorry, we need a cosigner." Kevin's confused. He asks what changed. The landlord shrugs and says it's not him, it's the number. A 3-digit score generated by a company Kevin's never spoken to, never signed a contract with, and never agreed to be judged by. Kevin didn't choose this company. He didn't choose to hand over his financial life to them, but somehow they hold the keys to his apartment, his car loan, even his job applications. And the deeper Kevin digs, the more unsettled he becomes. Because this isn't a government agency. It's not a court. It's not even a bank. It's a private, for-profit company that watches everything Kevin does financially, packages it into a number, and sells that number to whoever wants to judge him. And here's the part that really gets under Kevin's skin. Whether he succeeds or fails, whether his score goes up or crashes through the floor, this company gets paid either way. This is the credit score scam explained.
But first, we need to understand what a credit score actually is, and more importantly, who's behind the curtain pulling the strings. Because most chucks assume credit scores are some kind of official government measurement, like a passport or a driver's license. They're not. There is no single universal credit score. Instead, there are 3 private companies, Equifax, Experian, and TransUnion, each running their own models, each selling their own version of your financial worth to anyone willing to pay. Together, they form what's basically a private oligopoly with almost zero competition, holding detailed financial records on over 200 million chucks in the US jungle alone. And here's the kicker. None of these chucks ever signed up for this. You didn't open an account with Equifax. You didn't agree to their terms of service. Your data just ended up there anyway, scraped from your banks, your lenders, your landlords, your phone company, anyone who reports your payment behavior. It's like waking up one day to discover 3 strangers have been keeping a detailed diary on your entire financial life, and you're not even allowed to read it for free.
So how did 3 companies end up controlling something this important? Well, it goes back decades, when lenders needed a faster way to judge risk than just calling around and asking. So these bureaus built massive databases. Then, in the 1980s and 90s, the FICO scoring model came along and standardized the whole process into one number, between 300 and 850. And once that number existed, it stopped being optional. Landlords started requiring it. Employers started checking it. Insurance companies started pricing policies around it. Even some utility companies use it to decide deposit amounts. In other words, this private number quietly became mandatory infrastructure for participating in modern jungle life. You can't really opt out. Try renting an apartment, financing a car, or getting a credit card without one, and watch how fast doors slam shut. So we've got 3 unelected, unaccountable companies essentially controlling access to housing, transportation, and credit. Surely they take that responsibility seriously, right?
Well, here's where things get interesting. Because if Kevin assumed these bureaus make their money purely from lenders paying for accurate risk assessments, he'd be missing half the picture. Sure, lenders pay for credit reports and scores. That's the business model on the surface. But there's a second revenue stream running in parallel, one that depends entirely on chucks being worried about their own scores. Because these same bureaus also sell credit monitoring services, identity theft protection, and score tracking subscriptions directly to consumers like Kevin. Think about that setup for a second. The companies grading you are the same companies selling you the tools to keep an eye on that grade. It's like a teacher who writes the exam, grades the exam, and then charges you extra to find out which questions you got wrong. And because your score can swing based on factors largely outside your control, hard inquiries, reporting errors, even how your data gets misread, there's a constant manufactured anxiety that keeps Chuck subscribing to these monitoring services. Worried your score dropped for no reason? That's $19.99 a month to find out why. Scared someone stole your identity? Better sign up for protection. sold by the exact same company whose security failures have made identity theft a national punchline. Which brings us to the moment that should have ended all consumer trust in these companies forever. Because in 2017, Equifax, one of the 3 bureaus holding your most sensitive financial data, suffered a massive data breach. We're talking social security numbers, birth dates, addresses, even driver's license numbers for roughly 147 million chucks, nearly half the entire jungle's population. Let that sink in. A company whose entire business model is protecting and monetizing your financial identity got hacked so badly that almost half the country's sensitive data ended up exposed. And how did Equifax respond? They eventually agreed to a settlement of up to 700 million bananas with the FTC. Sounds like a lot, right? Except once you divide that among the actual affected chucks, most people qualified for a payout of around 125 bananas, if they were lucky enough to file before the settlement fund ran dry, which it did almost immediately. Some chucks got nothing at all. Meanwhile, Equifax kept operating, kept signing new contracts with lenders, kept selling monitoring subscriptions to chucks worried about identity theft, the very crime their own negligence helped enable. Sensational. So, if Kevin's wondering whether the consequences ever stick, the answer is not really. Because Equifax isn't even an isolated case. All 3 bureaus have faced repeated fines and settlements over the decades for issues ranging from inaccurate reporting to deceptive marketing of their paid credit products. The FTC has gone after these companies multiple times for misleading consumers about whether their credit scores were even free. And yet, structurally, nothing changes. No breakup, no real oversight overhaul, no alternative system introduced. Just fines that amount to a rounding error against the billions these bureaus pull in every single year. It's the cost of doing business, baked into the budget, baked into the system. The punishment changes nothing because the business model that caused the harm in the first place stays exactly as profitable as it was before. But let's say Kevin somehow avoided ever being caught in a breach. Let's say his data stayed perfectly safe. He'd still be stuck dealing with the actual scoring models themselves, and these aren't as neutral as they seem. Because credit scoring algorithms weigh factors like length of credit history, types of credit used, and credit utilization, factors that sound technical and objective on paper. Except research from groups studying lending patterns has repeatedly found that these scoring models produce disparate outcomes across different income brackets and demographics, often because of structural inequalities baked into who even gets access to traditional credit products in the first place. If your family never had a mortgage, never had a credit card, you start the race already behind, through no fault of your own. The algorithm doesn't ask why you don't have a long credit history, it just dings you for it. And if Kevin ever finds an actual error on his report, something genuinely wrong, a payment marked late that was actually on time, a debt that isn't even his, good luck getting it fixed quickly. The dispute process is famously slow and opaque. You submit your claim, the bureau forwards it to whoever reported the information, and that party essentially gets to grade their own homework on whether the claim is accurate. Studies and consumer complaints filed with regulators have shown that a significant chunk of disputes get resolved in favor of the reporting company by default, simply because verifying every claim properly would cost these bureaus time and bananas they'd rather not spend. Meanwhile, Kevin's stuck with a damaged score, watching loan offers disappear and apartment applications get rejected, all because correcting someone else's mistake isn't profitable enough to prioritize. So let's go back to Kevin, standing in that apartment lobby, being told he needs a cosigner because of a number he didn't create, can't fully see the formula behind, and can't easily challenge if it's wrong. He goes home, anxious, and decides to sign up for a credit monitoring subscription just to keep an eye on things going forward. Which means Kevin is now paying monthly bananas to the exact same industry that profits from his uncertainty, sells his data to lenders behind the scenes, occasionally leaks that same data through preventable breaches, and faces little more than a slap on the wrist when it all goes wrong. Whether Kevin's score goes up, these companies get paid by lenders eager to extend him credit. Whether his score crashes, these companies get paid by Kevin himself,
desperate to understand why. There is no outcome in this system where the bureaus lose. Heads they win, tails they also win.
And that's really the heart of this whole jungle setup. A private industry with almost no real competition, holding mandatory influence over housing, employment, and credit access, monetizing both your success and your failure, facing fines that barely register against their revenue, and offering a dispute process slow enough to ensure most chucks give up before getting a fair resolution. Kevin didn't choose this system. None of us did. We were just born into a jungle where 3 companies decided to turn financial trust into a subscription service.
So the next time your score drops for reasons that don't seem to make sense, or you get denied for something you were sure you qualified for, you'll know what's actually happening behind the scenes. For legal reasons, this video is nothing more than the ramblings of a paranoid schizophrenic about woodchucks in a make-believe forest. Please do not sue Chuck. And a massive thank you to the generous members of the Chuck Republic for bankrolling these videos. You're all truly wonderful. Stay safe, and we'll see you in our next video.